Good morning. It's Friday morning. Just want to remind you this channel is all things financial zero. Anything else is not me. And there are at least 50 copycats accounts out there. So, all things financial zero. So, our last two videos, we talked about first the basis trade. And what we talked about with the basis trade is that the Federal Reserve and the Treasury, for some reason, believe that the hedge funds, 10 or 11 of them in the Cayman Islands, had around $455 billion worth of treasuries that they were using for the basis trade. And then they found out that they were a little wrong. It was $1.85 trillion worth. Okay. So that's one, two, three, four, 5 times as much. Right. How could that happen? But who knows, right? Then yesterday we talked about the yen and what's going on in Japan. So this morning, and I should say, in both of those videos, I didn't even realize it. When I did the basis trade, I was forced to talk about the yen carry trade. And when I talked about the yen carry trade, I was forced to talk about the basis trade. And yesterday I was walking my dog Domino. By the way, Domino is doing, I would say, very well. He'll never be 100%. I'd say maybe he's like 80%, but we can go on walks again. So everybody, thank you for paying attention to that too. So Domino is going to be fine, it looks like. At least that's what the neurologist says. Now, what we want to talk about here is what was in the Asian Times this morning. So as you know from my video yesterday, we believe that the yen was going to go down. All right. And I understand the United States wants it to go up and all this other stuff, but let's see what these say. Now, here's the first paragraph. The other day, the yen plunged to 155. Everyone noticed, just like I did. As soon as I saw that, I was like, whoa, this is something we need to pay attention to. Now, the Japanese finance minister has a warning for foreign exchange dealers not to test their resolve as the yen hits the lowest level in 9 months. This means she's going to intervene. But let me tell you something. This is a fact. If a country is fighting the markets on their currencies, they will lose. Okay? It's just they will lose. You can't win in a currency war with the market. But doesn't mean they're not going to try. Doesn't mean they're not going to hit them. And doesn't mean they can't hurt them. It just means they will lose in the end. So in July 24, the yen hit 160 and then massive intervention by the BOJ. But since then, we have the new prime minister, Takachi, and she's attention on boosting export via a weaker yen. And not only that, we also know she's doing a stimulus bill, which for the Japanese is just printing more debt, which again is going to weaken the yen. There's just no question, and weaken their bonds because the more bonds they issue, the higher price they're going to have to, interest they're going to have to pay. That's what's going to happen. So they talk about Trump in the first one, and that UDIDA has held the interest rates, steady all year. But he said he's looking to tighten again in January, February. We'll see if that happens. Takachi is basically Donald Trump when it comes to interest rates. She thinks they should be lower. She doesn't care what the inflation is. She just thinks the interest rate should be lower. So this says the traders, the people to worry about, thinking a drop past 160 is inevitable, okay, which is what I said yesterday in the video. And they say that their inflation rate is already 3%, above the BOJ's 2%. But again, you got to remember something. They're doing it sans food. It's 3.7%. Their short rates are 50 basis points. Their long rate is like 120, something like that. Their interest rates are not high enough for the inflation rate. But we're talking about the economy, trade, and so forth. Now, here's something I didn't know. The scale of the yen depreciation in the recent years is startling. They're actually saying that in a real effective terms, it's worse than the Turkish lira and the Egyptian pound. Nothing has fallen more than the yen in real terms. And so this is sparking debates on how much farther can it go down, all right? And which forces the bank, when you think about it, forces the bank to cap long-term bond yields via open-ended bond buying. What do we call open-ended bond buying? we call QE. Okay. So they say here Japan is a cautionary tale letting debt rise unchecked because that transfer weak debt dynamics into currency depreciation. Something we should pay attention to here in America, no? And as we've warned before, Japan could be facing a Liz Truss moment, which they mentioned in the first paragraph. And the second paragraph talks about the yen carry trade. And the third paragraph says, the investment funds have borrowed cheaper than the yen for the last 25 years. It has become one of the globe's most crowded trades, i.e., one of the biggest, and one uniquely prone to a sharp correction. And they say here, the last of the paragraph, this article, is that the weak yen is good news for nobody. So how does this fit in with the basis trade? Okay, so let's go back in time a little. Here's our debt now. It's 36. We know it's 38 trillion, but as we know, we're going up like 2 trillion, 3 trillion this year. And you can see who owns our debt: the foreign, the Federal Reserve, Social Security, and other investors. All right. Now here's December of 2007. Who owned U.S. Treasuries? And I'd also say, we started on the great financial crisis, probably like September, late August, September, right? And so I would say that this is a little bigger than it was in August, September, probably around 40%, 45%. Now it's 52%. But that's not what we're looking at. Look at over here. Private is 2 point, insurance companies 1.7, mutual funds 3.88, other investors 3.47%, very small percentages. And this is what central banks held the most, because central banks in 2007 were the biggest holders of treasuries, okay, in 2007. So Japan, mainland China, UK. Why UK so big, small country? They're a financial hub. You need treasuries in a financial hub because everyone's leveraged to the eyeballs. Other significant holders: Luxembourg, Belgium, and Switzerland. What are these people? These are euro dollars, okay? Different thing, we'll do a video on that at another time, okay? All right, so this is what interests me today, all right? Here's the people who own our treasuries. And you can go through them, and what I'd like to say here is they're saying these are foreigners, all right? And think, we have 38 billion. The Federal Reserve has, like, let's say 7. The Treasury has 3. That's 10. Now you're down to 28 billion. The central banks own like whatever, I think 13. Now you're down to 15 billion. Now we're looking at everybody else, and out of that other 15, we have 9 trillion here. Okay. Here's the rub. Look at the Cayman Islands up in the left-hand corner here. 455 billion. We know that's wrong. It's at least 1.85 billion. All right. Now look at the rest of the circles. So Cayman Islands is bigger than China, bigger than all others, and all the others are multiple upon institution. So really, we're looking at Japan and the Cayman Islands. All right, 2 huge treasury positions. What do they have in common? Both these positions are highly leveraged positions of U.S. Treasuries. I would say Japan is highly leveraged. Cayman Islands is extreme leverage. And they are now the 2 biggest holders of U.S. Treasuries, kind of like a barbell. And here's the deal. If the basis trade breaks, it's going to break Japan. If the yen carry trade breaks, it's going to break the Cayman Islands. So here, if we go into some kind of financial issue, doesn't matter what it is, and people need cash, these 2 are going to sell treasuries. So our treasuries could be going down in price, up in yield, and the government may be forced to do a major QE to buy all the treasuries coming out of there. Don't tell me I'm wrong on this. Remember what the OMFIF paper said. We should create a facility just to buy the Cayman Island treasuries when the trade breaks. So we got issues in this world, leverage and lying on our pricing and everything. But I really believe that our biggest weak nexus point is the U.S. Treasuries and the Cayman Islands and the yen carry trade. What do you think? What should we do about this? I mean, I think we should take down the Cayman Islands, but again, no one's listening to me. So like and follow. Remember, all things financial zero, and thank you.